Good morning, good afternoon, everyone. This is Meherban Faroogh from 1000 Pip Club. I'm glad you could make it. Today is our first of the series of classes we'll be doing every Wednesday. I don't want to make a big introduction about 1000 Pip Club, but the founder of 1000 Pip Club is Jeff Langan, and I've been learning from him and working with him and Dime for the last 3 years now. He's an awesome teacher, trader. Everything I know today is thanks to him. I've been conducting the currency analysis classes for the last 3 years now, and I'll talk a little bit more about it as I go along. We do it once a week, along with Dime, who's also a fabulous teacher and a trader. She'll be taking the class next week, and then kind of we'll take turns from there. In our experience, what we found, now before I forget to mention Vicky, thank you so much for moderating these classes, and I'd like to thank FX Street also for giving us this opportunity. It's a pleasure to be here. Thank you guys. What I found in my experience of teaching the basic and the intermediate level classes is what really makes sense for the students is the last piece there, what we refer to as the live currency analysis classes. And so what happens here is once we walk you through essentially the basics and almost intermediate level, you'll get a good sense. And again, depending, and I'll try and gauge some of you at what level you are, whether you are at the beginner's level, experienced level, or successful level, as we term it. But if you're somewhere around the basic or the intermediate level, you will find these sessions, in my humble opinion, very helpful. Okay. And the first few sessions, big picture thinking, currency neighborhood, chart reading and technical analysis, interest rates, credit rates, and how to write a currency trade plan. We hope to bring you to a certain level where you feel very comfortable to look at any pair and understand multiple time frames, identify some of the key support resistance levels, some look at some Fibonacci. Now, support resistance and Fibonacci really works, guys. Now, a couple of things I need to kind of set the tone right. And I know for a fact a lot of speakers have been talking in FX Street. So most of the things I may be saying are probably repetition, and I apologize. I didn't have a chance to go through all the webinars. I went through some, but you can take what resonates with you, what I say, and what doesn't resonate. You can just leave it out. But we'll kind of play along and see what works for you and what doesn't. But a couple of things up front. Trading currencies is not just about technicals. It's not. It's about technicals and fundamentals, and you'll hear me talk about this a lot. When it comes to fundamentals, you have to be a PhD in economics. I absolutely do not agree with that. But at the same time, you need to have reasonable level of understanding as to what the heck is going on in the world, right? If you don't have an idea of what's going on in the world, for instance, if you don't know the October 23rd summit that's taking place in the EU right now, and what are they discussing, for instance, increasing the EFSF from $440 billion to $1 to $2 trillion. The Greek bond, initially they agreed on taking a hit of 21%, and now they want to go to 50%. And while Angela Merkel and Sarkozy are all for it, not everyone is on the same page. And recapitalizing the banks. So these are three key agenda items there, right? So you need to, and over time you'll do this, and I'll hopefully be able to teach you how. And a lot of it will come from your own experience, just coming to classes. And again, you'll find me at times I'll be a little blunt, and I don't mean to be rude, but I'll say it as things come to mind. But just by attending some of these classes, you won't really get it. So what we will be able to pass along to you, like all the other speakers, is knowledge, right? We'll share our knowledge. But a lot of it comes from you doing it yourself, okay? Sitting on the sidelines won't help, which is why, and this is again how we've done it for the last 3 years on our site, and this is what we plan to offer on FX Street. What Dime and I will do is we'll help to push you along a little bit, okay? Now, if you're one of the serious traders, I think you'll like that. Now, when I say push along, we'll do it very nicely, and try and critique your plan, but, we understand you're new, and so gently, we'll try and point out where you can improve. If you miss a certain support resistance level, we'll point out to you. If you miss a certain fib level, we'll point it out to you. If you're trying to go long and you shouldn't be going long because there's some fundamental out there that you are not aware of, we'll point out that to you. Not just we'll point out that to you, we'll show it to you, whether it's on Bloomberg or whatnot. So you'll start getting a good sense of, and so the way I say it, generally is, when you kind of come out from school, university, whatnot, if you've done your MBA, whatnot, from another, I don't care if you've done it from Harvard or MIT or London School of Economics, wherever, that's great, right? You already have an edge, and especially if you're top A students, you already have an edge over the millions and millions of people who try and join the workforce, right? But just because you got that designation, right, from the top-notch school in the world, doesn't necessarily make you eligible to become the CEO of a top Fortune 500 company. What gets you from qualifying as an MBA or an engineer or a doctor or whatnot to becoming the CEO of a top Fortune 500 company in a couple of years is a lot of hard work and experience. You have to make it your own. And that's what currency trading is all about. So I want to set that tone up front. It's good to set expectations clearly up front, and Dime and I will again do our best to guide you as best as we can. So that's kind of the plan for the next few weeks. I believe Maud or Ricky has already scheduled these classes, so feel free to sign up. And over time, the other thing we'll do, and I haven't figured out completely right now, but for starting November 23rd and onwards, when we do our live currency analysis classes, we would request, some students to willing to step up and take the challenge and be bold and learn, is to submit their plans in class. So for that, I believe there's a fxstreet.net site. And again, I haven't figured it out yet, but we'll set up a group there. And on that group, what I would suggest is just before class, take your time, try and make sure your trade is a little bit current. So don't plan it like for 2 days before and finish in class. If you're taking class on Wednesday, try and do it like 3 or 4 hours, 5 hours before the class, so it's a little bit current, and send it on that site. Dimi and I will pick it up from there, and we'll kind of go through your plan and guide you. Trust me, you'll have a lot of fun. And for some of you, it'll be a learning experience. One thing I tell my students at times is, if you're new to this currency classes, and if you do it dedicatedly for 10 straight attempts, if you make a conscious effort, you try your best, right? You just try your best. That's all you need to do. If you try your best and you send in a currency analysis plan 10 straight weeks, I can almost guarantee you, especially if you're a beginner or intermediate level, I can almost guarantee you by the 11th time, you will feel the change. You will feel it actually. Now those who will not be sending the plans will still learn, but it's nothing like doing it yourself, right? Now again, I'll say it up front, these sessions are only for 50 minutes. So I encourage all of you to send in plans, but if there are times we're not able to go through all, I apologize up front, and we try and best and rotate plans as much as we can. So the other thing about those plans is we can do any 28 pair at any given point in time. So they mean I don't look at all the 28 pairs, that are made up of the 8 currencies, but you can pick up any 28 pairs and we can do it live at any given point in time. Okay. So that's a little intro about what's coming up. This is a typical journey that I've been through, that I know my friends that I trade with have been through. It doesn't necessarily have to, you don't necessarily have to be through the same journey yourself. And the reason I put up is because if you're somewhere along this path, if it resonates with you, great. If it doesn't, as I said, one of those things, just leave it on the side. But you should know that, again, like anything significant in life, Forex also takes time, okay? If you got into Forex thinking it's easy, I hate to be the bearer of bad news. It's not easy. If you can still get your money back, go ahead and do it. Is it impossible? Absolutely not. Is it difficult? Yes. It is something that you can get within a week. Unless you're a genius, I can't do that. Even if I have the right approach up front, I can't do that. Okay, it takes a certain amount of time to understand the nitty-gritties of Forex, and then it takes a little bit longer to test them out in real time, stick with it, understand how your price chart, why your price chart moved, why is a very important root cause. Why did the euro move, or why did the pound move, or why did all the US pairs move, or why did they move against each other? What happened? What news was out there? And then kind of stalk it, understand it. And that's what experience does for you. That's what experience is. You keep repetition. You keep doing it enough times and you go, oh my God, that's how it works. Now, the funny part is, you keep doing that, and because there's a certain economic situation in the world at that point in time, and that may work for you, a year or two down the road, things may change. Things are in a constant change in the world. I don't need to be saying this to you, and it shouldn't come as a surprise to you. Every 3 or 4 years, things change, right? So the way you may be thinking about the market or working at the market may not necessarily work a couple of years down or even a couple of months down. And that doesn't necessarily mean that the system is incorrect. That just means you need to adjust your thinking primarily around fundamentals, hint, hint, and adjust to the current framework of the market and kind of go with there. So I'm saying a lot of things that come to mind. By the way, one thing, the way I like talking is I don't have prepared speeches. I kind of talk just from experience. So you might hear me at times kind of fumbling, and I apologize, but I kind of try and make it a little bit extempo. I feel a lot more comfortable that way, and students tell me they find it helpful that way too. So this is the typical journey of what we refer to as a best trader. And again, there's no rocket science to the word best. I just use that term because it ties very nicely with what we refer to as essentially the 4 levels. Either you're a beginner, somebody who's just started Forex or has been at Forex for quite some time, but not necessarily been very successful. Or the next level is someone who's experienced, has seen some fair amount of success in a demo account, whatnot. Either you may have a live account or may not, or if you have, you're not as successful in a live account. In a successful category, you are successful. You got it. You pretty much got it at a successful level. You've doubled your live account in less than 6 months or so, and you keep doing that. You have control over your emotions, something that's very difficult. And technical fundamentals, whatnot. So you have it. You have what it takes. And essentially, the top level is essentially when you reach that level, you keep excelling. Okay, so I still have to meet a top-notch Forex trader who claims that he knows it all. I think the market can make you a very humbling personality very soon. It can humble you very soon, right? So there's nothing like I got it all. There's always a lot more to learn. So somebody who's reached that successful level on a daily basis, which is essentially Jeff, the way I see it. I founded the 1000 Pip Club. He, on a daily basis, he keeps doing research. He keeps learning what's going on, and so he shares that with us. So that's kind of the 4 levels that I look at. So that smiley face, and there might be a little, I have to apologize, there may be a little bit lag between what I see on my screen, what you see, like a 5-second lag. So there is, just be a little bit patient. So that smiley face there essentially is us people, the retail people. Now, since I'm out of the retail part, you'll hear me talk about Forex traders essentially in 3 categories: Tier 1, Tier 2, or Tier 3. Once again, Tier 1, Tier 2, or Tier 3. I guess most of us know by now that the Forex is the largest market in the world. There's about, the last I checked, there's about $4 trillion a day, $4 trillion a day. That in terms of volume that's traded in Forex every day. There are 8 major currencies, the US dollar, Canadian dollar, euro, pound, British pound, Swiss franc, Japanese yen, Aussie dollar, and Kiwi, or New Zealand dollar. And there are 28 combinations of these 28 possible combinations, right? And again, for our classes, we'll do all 28 at any given point in time. The point I'm trying to make here is against certain currencies like Euro, like Euro US, have taken most of the chunk of trades, so on and so forth. But where I was going with this is when it comes to number of traders, and I again, I don't have a report in front of me. I don't have stats. I'm just using common sense logic. If there are millions and millions of traders out there, people like you and me, right? People like you and me are referred to as retail traders, right? We can have accounts. I don't know. So some of these platforms can open up an account for you even with $100, right? So right from $100 to I don't know $500,000, right? Essentially, I'm just throwing a number, $1 million maybe. I don't know. Are retail traders, and you'll have tons and tons of retail traders. That is what level 3, right? That's level 3. Level 1, the way we refer to it, are the macro funds, the big time funds, the sovereign, the Chinese sovereign fund, the George Soros, the PIMCOs of the world, the Bill Gross, the LRN and PIMCO, or BlackRock. I mean, these names, hedge funds, Citibank, Bank of America, big banks, big hedge funds, big sovereign wealth funds. And trust me, there are a lot of sovereign funds out there, from China to Saudi Arabia to you name it, UK, who trade currencies among other things, right? And then so those macro funds, if you think in terms of numbers, individually. So when I say numbers, I mean Citibank is 1, right? Or PIMCO is 1. I'm not referring to the 150 traders that may be in Citibank. As an institution, Citibank is 1, just because of the size of wealth that they manage. They are what? Less than 1,000. I'll be surprised if there are 1,000 in the world. But let's say there are 1,000. So if you look at what I'm trying to say, 1,000 over millions of people who trade, it's what, 0.01% or something ridiculous like that. And again, I've not calculated my numbers, but less than 1% control probably 80-85% of the volume of Forex in the world. Okay, this is a very important thing for you to understand. This is part of the big picture thinking you need to kind of bring into your mindset. Because the way these top less than 1% people think and execute, if you can get to that level, that's what makes you a successful trader. Okay, you may have heard terms like, depending again, I apologize, I don't know at what level you guys are right now, but terms like, trend is your friend, follow the trend, stuff like that, and that's all great, and I'm all for it. But between following the trend, there's a lot of other things that you need to keep in mind. So what I wanted to kind of share here is, if that little smiley face, innocent smiley face is us, the journey a typical retail trader goes through the initial few years, and again, someone like myself is generally lost, right? You're between buying all different kinds of softwares or trading or robots or tools from forum to forum, whatnot. I mean, that's reality. That's what most people go through. You're generally confused. I mean, you try out a couple of things. Some work, some don't work. You may be overloaded with a lot of indicators, and as you move along, you come across a lot of indicators, and you go, oh my God! I mean, you go through a feeling of finding the Holy Grail and so on and so forth. And one thing I'll tell you right now, having too many indicators is not good. Excuse me. Having too many indicators is not good. Having the right indicators is great. Now, again, each indicator was born for a purpose. Okay, I'll tell you that now. Try it out, right? You can backtest if you want, but I'm more a proponent of testing in real time versus backtest. Don't be in a rush to make money. That's one thing I'll say up front. When you're starting to learn Forex, please do not be in a rush to make money. If you are in a rush to make money, more likely than not, if you open up a live account, you'll lose it. One of the worst things that can happen to you, and this is again where I start getting candid, and I apologize if some of you are not liking it, but one of the worst things that can happen to you is you have beginner's luck. Okay, so you started, you heard of this fabulous program called Forex, and you got into it, whatnot. You opened up a $50,000 account live, and you got in some trades, and you were with the trend or things worked and you got into consecutive 5, 6, 7 trades that increased your account by 10, 15%. And you're like, oh my God, I'm the next best thing after George Soros. That's the worst thing that can happen to you. Because if you have no understanding of margin or leverage, right? If you have no understanding of stop loss or where to place a stop loss, if you don't know that Fibonacci's actually exist and top tier traders follow Fibonacci retracement levels and of course support resistance levels and whatnot, if you don't understand how to follow the fundamentals and that the fundamentals is what drives the price charts, more likely than not, since you don't have the right discipline, forget the discipline, since you don't have the right knowledge, you will over leverage yourself and do the things that you shouldn't do essentially, and you might end up losing your account. Okay. Again, I know people who've done that. I feel sorry for them, but that's reality. It takes me back to the point. Don't be in a rush to make money. Be in a rush to learn. Definitely be in a rush to learn this market. Okay. And like anything else, guys, whether it's, I keep going back to being a doctor, engineer, or whatnot, it'll take you time. Okay. To my knowledge, nothing of significance in life comes to you easy. It takes time and effort. The good news is you have the support and structure through FX Street, so use it. They've done an amazing job here. So as you move along this journey, right, you kind of find some tools or softwares or indicators, some things work, kind of going along a little bit. You find highs, you find your highs and you find your lows in that journey. And there comes a point where you may think, should I give up, right? Because the time has elapsed. Now again, this time, as I said, so for some of you, it could have been a few months, for some of you, it could have been a few years. And for me, it was years, quite frankly. You decide whether you want to give up or you keep going on. Once again, at that point, I'd like to say that everybody is born for a purpose. I mean, some people are born to be CEOs, some people are born to be doctors, some people are born to be Forex traders. So decide what you want to do. But if you carry on, things will come your way. Again, if you have the desire to succeed. Now, this is a very interesting quote. I think this was, I picked this up at one of the sessions I was attending. I think this quote is from Bill Cosby, if I recall correctly. And I just love this quote. It says, when your desire for success, or rather your desire to succeed, becomes greater than your fear of failure, I think that's when you start to excel. And that's really, I think that's really true. So you pull yourself together and you start looking for the right answers and you start realizing that it's not that bad. Once again, as you do that, you move along and then, like all of us, life gets in the way, whether it's job, family, whatnot. Again, you can decide to give up or you can continue to move on. As you continue to move on, and again, look for the right knowledge, you find the knowledge, you put on experience to it and you start becoming a successful trader. I won't go through all of this here because I think I've been through most of it and I'll go through most of it in the future slides. I don't want to take up too much of my time. I'm already at 6:21. But having the right knowledge on big picture fundamentals, market timing, tier 1, tier 2, tier 3, how they trade, what are the profit taking levels, fear versus greed, and, blending in all that experience. Now, this is very important here. Relationship between interest rates, inflation, and growth. And I'll talk about that. It took me a long time. It took me a long time to figure out how should I look at fundamentals. What am I looking for? Is it the building permits? Is it non-farm payroll? Is it unemployment rate? Right? Is it retail sales? Is it CPI? What am I looking for? And then how am I supposed to trade that? Should I trade it half an hour before? Should I trade 2 hours later? Oh, and by the way, should I just look at the US side or should I look at the euro as well? And what does it have to do with support resistance? And I was so confused. So over time, and I was talking to some of my friends who are actually economists, I realized, and again, this is the way I look at it, and I'll talk about it a little bit, that I think it's all about interest rates, inflation, and growth. Whether it's your news events, calendar news events, or the statements made by Trichet or Merkel or whoever, Bernanke, it's all about interest rates, inflation, and growth. Okay, so kind of you get at that level, and then, as needless to say that you get at that level through a lot of dedication, hard work, like the won't quit attitude, the right knowledge, enough practice, and The last one is very critical for me, humility. No matter how successful you are, if you remain humble, I think you'll do well in life in general. And then once you reach that level, you strive at becoming better every single day. You strive at thinking, at researching how those top-tier funds think and do, and you just continuously keep improving. So just very quickly, it'll just help me for this and for the future classes to get a sense. Just take a quick vote, if you don't mind typing in your chat boxes. At what level do you think you are? Are you a beginner? As a beginner, somebody just started Forex, could be a few weeks, days, or months, or even years. But you feel you don't have a very good, sense of technical fundamentals, timing, etc. You're treating a demo account. You've never traded live. Essentially, that's what a beginner is. An experienced is somebody who has, in my opinion, a good understanding of technical fundamentals, but not enough. And is trading a live account for the last few months or years, but it's not very successful. So you have experience, but you're not kind of successful. And successful is somebody who has the right knowledge and experience, and essentially has doubled the live account in less than 6 months and continues to do so successfully. So just very quickly, type a B if you're a beginner, if you think you're a beginner, and if you type an E if you feel you're the experience category, and type a S if you feel you're been very successful. So maybe I learned from you too, and I'm not joking. I'm always willing to learn from people who have something else to share that's worked for you. So a few of you are typing in. That's great. I'm seeing a blend of a lot of your experience. That's great. Experienced, beginner, experienced, beginner. So between experienced and beginner. Here between experienced and, generally the class is between experienced and beginner. And that's great. Great. Thank you, guys. Okay. So I think as we move along, you'll find, a lot of things, maybe what we say already, this, that's great. But when we get down to the live currency classes session, if you participate, we'll be happy to share our thoughts, Dimi and I think you'll find it helpful. Okay. All right. So let's talk about what is this big picture I keep talking about. And once again, I'm almost certain if you're regulars and if you attend these Forex FX Street sessions regularly, you must have heard a lot of speakers talk about big picture, right? Here's the way I see big picture. So first around technicals, okay? So when it comes to technicals, big picture to me is around three things. It's about the monthly charts, it's about the weekly charts, it's about the daily charts. Now, once again, it took me a while. Okay, it took me a while. It may have taken you a lot less time. That's fine. But it took me a while to really do this right, to really get this right. How do I look at monthly, weekly, and daily in less than 5 minutes, or 3 minutes rather, 3 to 5 minutes, and get a good sense on any new pair, Euro CAD, Aussie CAD, Pound CAD, whatever, Swiss CAD, Swiss yen, something that I've not been looking at, let's say, for the last few weeks or even months. If I look at it, how do I get a good sense? The 80-20 rule, how do I get a good sense, good feel of where the pair is headed? Now, before I forget to mention, and again, I'm sure a lot of people talk about this, you shouldn't just be trading off a 5-minute chart or even a 60-minute chart. If you're trading a 5-minute, 1 minute, heaven forbid, or a 60-minute chart without any clue of the trend or support resistance levels or Fibonacci levels on your monthly, weekly, and daily, I think you're doing yourself a big disservice, and you're at a high risk level. Now, my opinion, if I'm wrong, I stand to be corrected. But you need to have a good understanding of monthly, weekly, and daily, and that's part of what we refer to as multiple time frame analysis, which, by the way, is very simple. Once you get the hang of it, it's not that difficult. When it comes down to execution, of course, those are the lower charts, right? The 60-minute charts or the 15-minute charts or the 1 to 5 minute charts. Now, once again, earlier in my career, I was confused. Should I look at the 15? Should I look at the 30? Heck, if there's a 25-minute chart, should I look at a 25-minute chart? That's not what it's all about, right? It's almost about, if I say this correctly, if you imagine a magnifying glass, right? And let's say if you went to a restaurant and you kind of had a menu in front of you and some of the fonts were not clear, a magnifying glass, depending on your, strength of your eyesight or whatnot, you would move and I'm almost at my end here, I'm almost moving my hand as if I was holding a magnifying glass. Depending on the strength of your eyes or whatnot, or your vision, or how small the font is, and depending from restaurant to restaurant, you would move the magnifying glass closer to or away from the menu, right? And that's really what multiple time frame is. When you're looking at, let's say, the Euro USD or any new pair, you start from the monthly chart, look at the big trends, look at the big, very glaring in the face support resistance levels. I couldn't have said this better. Glaring in the face support resistance levels, glaring in the face Fibonacci levels, something that you can quickly draw, whether the pair is going up or down, and then kind of quickly drill down to the weekly and keep your monthly numbers there and say, okay, so in context of the monthly, where are my weekly, and then go down to the daily and figure out in context of the monthly and the weekly. Now again, it comes to technicals and fundamentals. If you've been following the fundamentals, you should have a good clue of why has a pair been going a certain direction. So you say, that makes sense. The trend is kind of along with the fundamentals, or it's not following the fundamentals, which in some cases may give you an opportunity. Actually, that could be a retracement opportunity that you want to get in. And along the way, so then once you figured out the right price levels that you want to look at getting in the trade, you're not in a rush, right? Of course, over the next 24, 48 hours or a week or so, then you go down, when the trade comes your way, essentially go down to the lower minute charts and then, try and execute that trade. Now, when you look across these time frames, and if you heard the term multiple time frame analysis, that's really all it is, folks. That's what multiple time frame analysis is, right? It's a magnifying glass. It's the taking of a pair, starting from the monthly, quickly going down, weekly, daily, and I'll show this to you in almost 5 minutes. You pick up any one of the 28 pairs, and I'll show you some decent price points. Maybe not today, later, next week, or whenever I'm doing one of my classes. Give me any one of the 28 pairs, and I'll show you decent support resistance levels, decent strip levels. Of course, if I was to take a trade on that pair, I would not take it just based on a 5-minute analysis. I would not do that, because there's a lot beyond that, parallel inverse analysis and understanding whatnot. But my point here is, what I'm trying to create the awareness, if you've not already heard it before, is do not just trade off a smaller minute chart. You're doing yourself a disservice. Some of the other things you need to be mindful of. So once again, chart reading, that's part of the multiple time frame. Support resistance, of course, I mentioned that. And again, if most of you are experienced, this should not be news to you. Fibonacci levels, very, very essential. We strongly believe that tier 1 traders definitely use both Fibonacci's and support resistance levels. Figure out whether pair is overbought or oversold, which again can give you good, decent opportunities. Again, in context of what's happening on the fundamental side, any statements that come out from Merkel or AIDS, or what Bernanke just said, or some news event that just came out, does that support or digress from the current fundamental, whether it's weak or strong, along with the trend, whatnot. Best times to trade, and parallel inverse analysis. So we can go through all that in some of our classes. Fundamentals, again, is a equal, to technical, something you need to know. When it comes to big picture, on fundamentals, again, as I said before, and I have a slide, I think, following this one. It's important to understand interest rates. How am I doing for time? It's 6:30. It's important to understand interest rates, the relationship between interest rates, inflation, and growth. And let me just make I'll talk about that in a couple of slides. Otherwise, I'm digressing. Understanding, for instance, what's going on currently, European debt crisis, you need to be familiar with that. Okay, what's going on, almost stalk it on a regular basis. In fact, before taking any trade, you should kind of go to Bloomberg. That's what I do. Under Bloomberg, go to news, then markets, and then currencies. And then typically in that currency section, the top, almost like 4 to 5 articles, 15 minutes reading, gives you a good sense. Now, If you're new, it won't be that quick. But if you're someone like myself who's been doing it for years now, you read a few articles and you're like, yeah, got it, let's move on. And there's something new you're picking up, a little statement here and there, and that's a little tweak. But once again, that comes from experience. If you're new, it may be a little bit difficult initially. But getting a good sense of what's happening on the European side, for instance, on the EFSF, right? The key is to increase it from 440 billion to somewhere upwards of 1 to 2 trillion. If they don't do that, it's a game changer. Okay, your Euro USD that's spiking long right now will fall. Period. Bank recapitalization. There's a lot of talk about recapitalizing their banks. If I recall correctly, there was some list of 50 banks that have been put up as key banks in the EU zone that should be protected. And again, nothing happens around there. So you don't have another one like Dexia, but it's a deal breaker. Greek bonds, if again they've already agreed on 21% haircut, the investors taking a 20% haircut, and now I think Merkel is proposing 50%. Initially it was 60, now she's proposing 50, and the market is kind of taking that positively, all these three together. But if any one of these three or all three don't fall in place, and again, if you're following the news, I think it was the day before or yesterday, I forget, Merkel's spokesman, I think it was 2 days before, Monday or so, made a statement that, oh my God, the market is over expecting, so we may not be able to get all the expectations as the market is expecting. So, and that resulted in the markets, in the risk currencies, we refer to them, the euro, the Aussie, the Kiwi, whatnot, shorting 100, 200 points. So, did that have to do all with support resistance? More to do with that statement, right? But if a pair typically hits a support resistance level or a fib level, it kind of pauses there. And that's what you're looking for, guys. That's what you're looking for, that nice little pause. Okay, nice little pause. You're looking for a nice little retracement against a strong trend, right? A decent retracement, not a 25 pip retracement, a decent retracement against overall trend that hits a nice solid support resistance, and hopefully, fingers crossed, a bunch of support resistance and Fibonacci levels. That's your strong level, where it's overbought, it's done kind of complete a daily move, and you get in the trade, it goes in your favor, 20, 25 pips, you lock it safe. You're not scalping. Again, I don't scalp. If it works for you, great, but in my opinion, over long term, scalping doesn't work. That's my opinion. I stand to be corrected if I'm wrong. But you're looking for that move in your favor to lock yourself safe and then ride out the trend, as it goes in your favor. Profit taking is very, very important. If the pair goes in your favor 100, 120 pips and you're just not taken off lots, you should change your strategy. Trade management is very important. Okay, so it'll come and take you. So you take off a few lots and you don't take off all of them again. So you want to ride that curve. This is why, again, you need to keep your ear to the ground, right? What's happening in the market. If you're short already, let's say, if you're short already, Euro USD, 35, 60 pips, whatever, and out comes a statement from EU summit after, October 23rd, whatnot, that the bank recapitalization didn't happen or the EFSF stays where it is, I can almost guarantee you, right? Depending again where the prices are, I can almost guarantee you it'll fall. Period. Okay. So if you're in a short position at that point in time, you want to hang on to that short position. You don't want to keep your stop loss very close, like 10 pips or 15 pips close to your price. You want to keep it a little bit further away, closer to your entry price. You want to, because there might be some spikes. That doesn't make sense, but nonetheless. Again, comes from experience, something you test out, where knowledge of fundamentals is critical. So that's the whole point I'm trying to make here. Just technicals won't cut it, in my opinion. Understanding the U.S. unemployment, and again, I just brought up U.S. because U.S. is, U.S. dollar is a safe haven. U.S. is a major driver. The fact that the U.S. Unemployment rate is at 9.1% and has been, I think, if I recall correctly, since the subprime crisis, 07, 08, whatnot, only once or maybe twice, it's gone below 9%. I think it went down to 8.9%, but generally speaking, it's at 9.1%, which is a very high rate of unemployment. That being said, in Europe, there's still a higher rate. So getting, understanding things like that is critical. Debt, what is it, 14.3 or even more at this point in time on the trillion dollars in the U.S. And again, what's going on in Italy, Spain, the downgrade that's happening almost every day, whether it's Spain or Italy, whether it's Moody's or Fitch, it all has a play, it all has a role. It comes down to, you hear the term risk on, risk off, right? So the mindset the market has is it a risk off day or risk on day, and generally that's something you'd be aware of. The fact that SNB has pegged its currency, Swiss franc, with the euro 1.2, it won't let it drop below, is important for you to know, right? Because if it comes down at 1.2, and depending how fast it comes down there from wherever it is right now, does it give you potential opportunity to put your stop loss just below 1.2, take a decent trade, or would you not risk it because the macro funds at this point in time are aggressively selling the euro Swissy? Things like that. You're saying with Bank of Japan, unlike Swiss National Bank, Bank of Japan also wants to protect its yen, but it's not taking any concrete steps. There's a lot of hearsay, there's a lot of statements, but not something concrete like what S&P has done. But I wouldn't be surprised if one of these days they do something concrete. In fact, I was reading something in the news today. And similarly issues around other currencies. So that's kind of the big picture. On the execution side, of course, as you're about to execute, you need to be familiar with, you must check Bloomberg, and what's going on, okay? Did Bernanke just make a statement? Did Merkel just make a statement? Did Merkel's spokesman said something? What was that in context to? Did Trichet mention something about interest rates? Did he just say that inflation is high, for instance, but we think it'll subside over the next 6 months? What does that mean? Does that really mean the interest rates won't go up? Yes, that's what it means, right? Because interest rates, inflation, and growth, that relationship is very important for you to understand. So the central bank's job is to maintain inflation in a certain range. So, and Forex, guys, is all about interest rates. It's about interest rate futures, by the way. It's about understanding interest rate, where the interest rate is headed. What's the sentiment? What's the expectation of interest rates, right? And as you keep getting good at this, you improve. So there's a statement here, really, you must check Bloomberg every time you place a trade. Yes, in my opinion, yes. And as I said, as you get good at this, it won't take you too long. So again, having a sense of when the NFP is and unemployment rate, all that stuff I just mentioned. Okay, so these calendar events essentially is what I would call execution, right? And I'm not suggesting you trade the news. That's not what I'm suggesting. But what I'm suggesting is having a big picture understanding of where are your monthly, weekly, daily charts, what's happening on the current time frames, what's the big context happening in EU, on the EU summit, for instance, what's happening in Australia. Is there a flood taking place somewhere? Is there a war going on somewhere? Is there growth issues in China? Are there inflation issues in China? Did China just reduce or increase the reserve rate of its banks? What does Trichet think about, or what does the new guy, I forget his name now, think about the interest rate environment? Those kind of things. The statements all over. And then just before placing the trade, checking in real time what's going on is very important. Okay, so along with that, of course, you need to have, guys, before I forget to mention, trust me, equities, your Dow and S&P especially, have a big influence on what happens in the currency markets. Okay, so understanding equity status is really important. Knowing who's the driver, what's driving it. Why? The question why is very important for any one of you who's done risk management. When you identify a risk, whether it's I'm talking about corporate risk, not Forex risk. So you identify any corporate risk, whether it's explosion or whether it's a fraud or whatever it is. You go and figure out how do you mitigate that, right? But before you do figure out how to mitigate that risk, the first thing you ask is, what is the root cause of this risk? How can the risk happen in the first place? Root cause analysis, cause and effect, right? Cause and effect. Forex is no more different. You need to understand what is the risk, right? Why do certain things happen? right? So if you see a price, and I hope this kind of makes sense, if you see a price go a certain way on the charts, on the technicals, you need to figure out why did that happen, right? And as you keep asking the question why, and you keep going back and forth between news and whatnot, you say, oh, so that's the reason. And more times than not, that is the reason. And so you start becoming good at this. That's what experience does for you. And then, you start making it your own, and you got to kind of get better from there. You need to have a good sense of optimism versus pessimism. What is the market mode at that point in time? Is it overreacting? More times than not, it is. The market does overreact. For instance, I personally feel at this point in time, I know I'm kind of exceeding my time limit here, but at this point in time, generally speaking, euro is weak, right? Surprise, surprise. And the statement that Merkel and Sarkozy together made last Monday, not this week, but last week, about, we'll support the euro and these are the three fundamental things we look for, and, good luck, and I hope they achieve that. But tough, very tough. So what the market is doing is the market is in a very pessimist mode, and that good news is essentially what's creating that optimism spike, as I call it. Great, that gives you good opportunities. Look out euro at 1.400, right? If it hits 1.400, there are some superb resistance levels and support resistance levels and fib levels there that you can take care of. Okay, I've got 5 minutes left, need to move on. Understanding the safe haven status of USD, yen, Swiss franc, fear versus greed. Now, when it comes to, once again, having the right knowledge and backing it up with your personal experience is critical here. Fear versus greed. Once again, this will be archived, so you can always go back and look at this. But essentially, what we teach at 1000 Pip Club is trying to figure out what we call as the underlying fundamental mode and the overriding fundamental mode. So the underlying fundamental mode essentially is driven by greed, where essentially there's too much optimism in the market or complacency, and it's all got to do with human nature. Carry trade is kind of doing very well. And you will see typically a trend, a bullish trend there. And the key here is that the underlying fundamentals during that state, economic calendar events, so calendar news events, they are in full play. That's what's driving the market more times than not. And then kind of this transitions into the overriding fundamental mode where events that are not on economic calendars, so statements coming out from people. So currently, I believe we're in an overriding mode where a statement out of EU or whatnot, would drive the market. It's pretty much it's a fear-based selling. Safe haven buying is the name of the game. Pessimism is there. There's doubt, there's worry, there's flight to quality. All these terms you keep hearing in the news. Now, the important thing to know is during times of greed, generally speaking, during times of greed or optimism, or especially when the underlying fundamental mode is there, the pace at which the price will rise will be less than the pace at which the price will fall during times of fear. Okay, and that shouldn't be a surprise again. So people in a panic mode sell much faster. So why is it important? Pips. You'll make much faster pips coming down versus making pips going up. So again, there's a carry trade impact, and Demi will talk about that. I couldn't come up with a better title, so I call it the World Scorecard. Once again, just to keep in mind, if you look at these are all the 8 currencies, right? So euro is 25% of GDP, US is 23%, whatnot. The key here to note is the unemployment rate in euro in the US is 9.1%. And if you look at this is the EU zone right there. Countries have all been bailed out like Greece, Portugal, Ireland. There's the limits there. I believe my numbers are right. I got them from CIA and Wikipedia, whatnot. Notice that Italy, for instance, is at 119%. Spain just got downgraded like 3 times. These ratings are outdated. I kind of updated the slide last week. But this kind of gives a general sense of what's going on. So let me get back to the crux of fundamentals. I kept saying that there are 3 things that drives, right? And I'll try and say it slowly and kind of pick it up from there. Forex is a game of interest rate futures. Okay, so if the market feels, let's say, that the Reserve Bank of Australia (RBA) is going to increase the rates in the near future, generally speaking, other things being kept constant, your Aussie should rise. Okay. And vice versa, if the market generally feels for reasons of CPI or growth or whatnot, that the RBA will reduce their rates, the Aussie should fall. So how does the market gauge that? It's based on inflation and growth. Generally speaking, and I know that I think in the US, the Federal Reserve wants to maintain inflation between 1.5 to 2%, right? So if, let's say, the inflation was at 3%, the way you control, and this is very important, guys, to understand, okay? The way you control inflation or you bring inflation down is you raise the interest rates. Once again, if your current inflation, which is represented by CPI, or the core CPI that you see on the calendar events. If your core CPI, let's say, is at 3% or expected to be 3 or whatever higher than your benchmark rate, between 1.5 to 2%, there's a good chance that the central bank of that country will raise the interest rates. Okay, so that expectation of rise in interest rates because of inflation is what will cause that country's currency to go up. Why do they raise interest rates? They raise interest rates because when you raise interest rates, it becomes less profitable for manufacturing concerns and factories and whatnot to borrow, okay, because there's more cost of borrowing. When there's more, so to avoid that more cost of borrowing, they will hold on to certain projects, whatnot. When you hold on to certain projects, what happens to growth? Growth comes down. So what happens to economy? It becomes less heated. What is inflation? It's a rise in prices because the economy is heating too much because there's too much growth. If you're following China, that's what's happening. They have a high inflation rate because they have a ridiculous amount of growth rate going on. Okay, so that whole cycle is important. So calendar news events essentially can drive that. These folks, man, from Bernanke to Merkel to Mervyn King, so all the central bank governors and politicians, prominent politicians, okay, when they make statements, it essentially drives the market crazy. Tier 1 traders from Bill Gross, PIMCO, or Fink and BlackRock, or just Soros, and essentially statements that they make or how they trade or so on and so forth essentially does drive the market. The rating agencies have lately they're putting a significant impact on what's happening in the markets. Again, the stock market crash, whatnot. So currently at the heart of all the fundamentals, there are three things. As I mentioned before, the Greek bonds taking a 50% cut, bank recapitalization, and EFSF increasing from 440 to $2 trillion. That's the key. I'll take just one more minute very quickly. And so let's say this was your 60-minute chart on the Euro USD, right? Pairs go up and down. So you can get some kind of a typical news there. It hit there because there's a 38.2% fib on some daily chart. It goes and it's a strong support resistance level, starts going sideways. Let's say there's some positive event that comes in that takes the pair back up long. Around here, it starts feeling a little bit overbought. So it kind of takes a dive. There's some profit taking that took place. Maybe, again, it hit a 61.8% trend. It's just an assumption I'm making, by the way. So the point I'm trying to make is, as your Euro USD slides up that curve, let's say it hits 1.440. Of course, there's a support resistance level, whatnot there, and some fib levels, so you will start thinking. So the question you would ask yourself is, if you're just looking at a 5-minute, 60-minute chart based on the bullish trend, and if you didn't have good understanding of fib, support resistance, or the big picture, you may end up taking a pair long at that point in time, whereas the right thing to do is probably to short the pair at that point in time with a 30 or 25 pip stop loss. Understanding technicals around there, understanding fundamentals I've been talking about this all this while, whether it's Euro bonds or the EFSF funds or the EU summit on October 23rd is very important. If you manage to get in the trade with a decent stop loss, and the pair goes, let's say, in your favor, 50, 60 pips. A question you ask yourself is, let's say you went short, and right at that time, Merkel makes a statement, let's say it's October 23rd or whatnot, that the EU meeting is not working out properly, or let's say the bank recapitalization didn't work well, or let's say the Euro EFSF fund, they could increase from 440 to even 1 trillion. What would you do? Would you exit, or would you stay in the trade? See, knowing your fundamentals at that point is critical, because what you should really do at that point in time, in my opinion, is you should stay in the trade. Because any negative news coming out of the EU summit, right, at such an important level at 1.40, especially at the time when the market is completely overbought, is huge. I won't have a chance to go through but I can take a quick minute to show you. So when you go talk about news, just go on Bloomberg.com, just hit on news. When you click on news, go under. So this is the problem I have to take care of. Sorry, just wait with me. Okay. So when you click on news, then go on markets. From markets, go on currencies. Okay. If you're new to news and if you're not very clear, just follow the spot, and in the currency section, try and read each and every article. Okay, for the first few days, you'll start getting a sense. You'll start getting a sense of how this market works. This is a website, by the way, the 1000 Pip Club website. This is what our syllabus looks like. There's a lot more to it. We kind of divided it into how you identify a trade, how you execute a trade, trade management. There's a cadet and a pro course. If you're just to sign up, you're more than happy to do so. Just go to fxstreet.com under services, click on educational services. You'll see this tab come up. You can go on 1000 Pip Club and you can read a little bit more on what we do. You can go over program description and kind of take it from there. It was a pleasure. I'm sorry I probably went a little bit over time. I'm done. If there's any questions or comments, I'll be more than happy to take them. I think I have for 1 or 2 minutes left. That's it. I'm done. Thank you, guys. Thanks, Maud. Thanks, Vicky.